This video will explain how to account for current liabilities. A current liability is a debt that a company reasonably expects to pay from existing current assets or through the creation of other current liabilities and within 1 year or the operating cycle, whichever is longer. Debts that do not meet both criteria are long-term liabilities. The different types of current liabilities include notes payable, accounts payable, unearned revenues, and accrued liabilities such as taxes, salaries and wages, and interest. In this video, we will discuss just a few of the common types of current liabilities, because previous videos explained the entries for accounts payable as well as the adjusting entries for some of these common current liabilities, such as salaries and wages payable. Companies record obligations in the form of written notes as notes payable. Notes usually require the borrower to pay interest. Companies frequently issue notes payable to meet short-term financing needs, but notes are issued for varying periods of time. Those due for payment within 1 year of the balance sheet are classified as current liabilities. To illustrate the accounting for notes payable, let's assume on September 1st, this company signs a $100,000 12% 4-month note maturing on January 1st. This company will receive $100,000 in cash, so the journal entry to record this transaction will debit or increase cash for $100,000 and credit notes payable for the same amount. If this company prepares financial statements on December 31st, it must make an adjusting entry to record 4 months of interest. The calculations for interest expense is the principal of $100,000 multiplied by the annual interest rate of 12%, and then we need to prorate the interest for the amount of time the note is outstanding. In this instance, it's 4 months or 4/12. The interest expense is $4,000. The entry to record interest results in a debit to interest expense for $4,000 and a credit to interest payable for the same amount. In the December 31st financial statements, the current liabilities section of the balance sheet will show notes payable in the amount of $100,000 as well as interest payable for $4,000. because both of these amounts will be paid within 1 year. At maturity, the company must pay the face value of the note as well as interest. It records the payment of the note as follows. We would debit notes payable for $100,000. We would also debit interest payable for $4,000 and credit cash for $104,000. Many of the products we purchase at retail stores are subject to sales taxes. Sales taxes are expressed as a percentage of the sales price. The selling company collects the tax from the customer when the sale occurs and periodically remits the collections to the state's Department of Revenue. Under most state laws, the selling company must enter separately on the cash register the amount of the sale and the amount of the sales tax collected. Gasoline sales are a major exception. The company uses the cash register reading to record sales revenue as well as sales taxes payable. If the March 25th cash register readings for this company show sales of $10,000 and sales taxes of $600, the journal entry would result in a debit to cash for $10,600, a credit to sales revenue for $10,000, and a credit to sales taxes payable for $600. When the company remits the taxes to the taxing agency, it will decrease or debit sales taxes payable and decrease or credit cash. The company does not report sales taxes as an expense. It simply forwards the amount collected to the appropriate agency. The company serves as a collection agent. Sometimes companies do not enter sales taxes separately on the cash register. To determine the amount of sales revenue, simply divide total receipts by 100% plus the sales tax percentage. If this company has total receipts of $10,600 and the sales tax rate is 6%, we can calculate sales by dividing $10,600 by 1.06, or if you prefer 106%, to arrive at our sales revenue of $10,000. The journal entry results in a debit to cash for the total receipts of $10,600 and a credit to revenue for $10,000. We can find the sales tax amount of $600 by either subtracting sales from total receipts or multiplying sales by the sales tax rate. Unearned revenue, also called deferred revenue, arises when a business receives cash in advance of performing work. The company has an obligation to provide goods or services to the customer in the future. When the company receives an advance, it increases or debits cash and increases or credits a current liability account, unearned revenue. When the company recognizes revenue, it will decrease or debit the unearned revenue account and increase or credit a revenue account. An airline company, such as United, receives cash when it sells tickets for future flights. In this industry, tickets sold for future flights often represents almost 50% of total current liabilities. At United, unearned ticket revenue is its largest current liability, recently amounting to more than $1 billion. Season tickets for sporting events are also paid for in advance. Let's assume that this university sells 10,000 season football tickets at $50 each for its 5-game home schedule. The university makes the following journal entry: a debit to cash for $500,000 and a credit to unearned ticket revenue for the same amount. The university reports unearned ticket revenue as a current liability. As the university recognizes revenue, it will reclassify the amount from unearned revenue to earned revenue or ticket revenue. As each game is completed, the university records the recognition of $100,000 of revenue with the following entry: a debit to unearned ticket revenue and a credit to ticket revenue for $100,000. Companies often have a portion of long-term debt that comes due in the current year. At the balance sheet date, all debts and obligations due within 1 year are classified as current, and all other debts and obligations are considered long-term. Let's assume this company has a 5-year interest-bearing $25,000 note on January 1st. This note specifies that on January 1st, starting in 2017, this company must pay $5,000 of the note. When the company prepares financial statements on December 31st, 2016, it should report $5,000 as a current liability because this amount will be paid within the next 12 months. The balance of $20,000 should be reported as a long-term liability. This is a great practice problem and very similar to one of your homework problems. The solution to this problem will be provided in another document. For most businesses, payroll is perhaps the most significant cost of doing business. The total earnings of an employee is the gross pay. Gross earnings less all applicable payroll deductions is the net pay. If Susan works 40 hours this week, earning a wage of $10 per hour, will she receive a $400 check at the end of the week? Of course not. Companies are required to withhold amounts from her wages. These payroll deductions must be paid to other parties such as the federal government. The company has a liability to these third parties and must report this liability in its balance sheet. Let's assume this company withholds amounts for FICA taxes as well as for federal and state income taxes. If these withholdings total $100, Susan will receive a check for only $300, which represents the net pay. Let's assume this company reports $100,000 in salary and wages expense, which represents gross earnings. This will result in a debit to salary and wages expense. In addition, it reports liabilities for the salaries and wages payable, as well as liabilities to governmental agencies. In this example, the payroll deductions are $7,650 for FICA, which will result in a credit to FICA taxes payable. We also withheld $21,864 for federal income taxes, which will result in a credit to federal income taxes payable. And lastly, we withheld state income tax in the amount of $2,922, which results in a credit to state income taxes payable. The gross earnings less all payroll deductions is the net pay, which in this example is $67,564. This company must withhold these amounts and make the tax payments directly to the appropriate taxing authority. So it is essentially serving as a tax collector. Social Security taxes are often referred to as FICA taxes. These taxes are imposed in equal amounts on both the employee and the employer. This amount represents the employee's share. This company then records the payment of this payroll by debiting salary and wages payable for $67,564 and crediting cash for the same amount. In addition to the liabilities incurred as a result of withholdings, employers also incur a second type of payroll-related liability. With every payroll, the employer incurs liabilities to pay various payroll taxes. These payroll taxes include the employer's share of FICA, as well as state and federal unemployment taxes. Companies classify the payroll and payroll tax liability accounts as current liabilities because they must be paid to the employees or remitted to taxing authorities periodically and in the near term. Based on this company's $100,000 payroll, it would record the following entry to record payroll taxes of $13,850 by debiting payroll tax expense. Payroll taxes include the employer's share of FICA. This is the same amount withheld from the employees. In this example, it's $7,650. It also includes both federal and state unemployment taxes. In this example, the federal unemployment tax is $800 and the state unemployment tax is $5,400. This is a great exercise to practice the two entries that companies make to record both payroll and payroll taxes. The solution to this exercise will be provided in another file.